If you walked into a silver shop today and saw empty display cases, that wouldn't surprise you. Shortages have been part of this story for a while. But imagine something far stranger. Imagine walking in with a bag full of silver, eagles, bars, real metal, and the dealer looks at you and says, "I'm not selling silver, and I'm not buying it either." That's not a shortage. That's a breakdown. This week, that exact scenario showed up on wholesale trade sheets in the U.S. silver market. On one side of the page, sold out. Every product gone. Nothing to offer. But on the other side, the side that's supposed to catch supply coming back into the system, one phrase appeared again and again: no bid. No bid means no price. No price means no transaction. No transaction means the market isn't functioning. Silver is trading near historic highs. Public demand is exploding. Industrial buyers are still lining up. By every textbook rule of economics, buyers should be fighting over supply. Instead, the largest pipelines in the physical silver market are refusing to buy at all. That's the moment you stop looking at price charts and start asking a more uncomfortable question. What happens when silver is valuable, but money can't move? This analysis is not about whether silver should be higher or lower. It's not a price call, and it's not a prediction. This is about liquidity, or more precisely, what happens when liquidity disappears from the middle of a market. What we are witnessing in silver is not a collapse of demand, and not a collapse of supply. It is the collapse of the mechanism that allows buyers and sellers to meet. Silver still exists. People still want it. But the cash, the short-term, operational money that makes transactions possible, is no longer flowing where it's needed. And when liquidity leaves the system, price alone can no longer keep a market alive. When people hear the phrase, "no bid," the instinctive reaction is simple: no one wants silver anymore. That interpretation feels logical, and it's completely wrong. No bid does not mean lack of interest. It means lack of capacity. In plain terms, it means the wholesaler is not willing or not able to name a price at which they will buy metal back from you. Not because silver isn't valuable, but because committing to a purchase requires something more basic than conviction. It requires cash, credit, and balance sheet room. And right now, those are missing. This distinction matters because it flips the narrative upside down. Demand hasn't vanished. In many cases, it has intensified. Retail interest is elevated, industrial demand remains steady, and international prices continue to trade higher than domestic quotes. None of that lines up with a market where nobody wants silver. What does line up is a market where the plumbing has failed. Markets don't operate on belief. They operate on settlement. Someone has to wire funds. Someone has to clear inventory. Someone has to carry risk, even briefly, between buyer and seller. When that intermediary step breaks, transactions stop, regardless of how badly people want the asset. This is why no bid is such a critical signal. It's not a statement about silver. It's a statement about the health of the financial infrastructure supporting silver. And here's the uncomfortable part. Most headlines will never make that distinction. It's far easier to say the bubble popped than to explain why a system designed around leverage and hedging can seize up at the very moment prices are rising. To understand how this happens, you have to stop looking at charts and start following the flow of money itself. To see where the breakdown happens, don't start with charts. Start with a normal day in the physical market. A customer walks into a local coin shop. He wants to buy silver. The dealer checks inventory, calls his wholesaler, and hears the same answer he's been hearing all week. Nothing available. Sold out. That part is already familiar. Then another customer walks in. This one wants to sell. He has real metal, eagles, bars, clean product. In a healthy market, this is where things balance out. The dealer buys the silver, sends it up the chain, and uses that cash to restock or meet other demand. But now comes the problem. To buy that silver, the local dealer needs cash. And to manage his cash, he relies on the wholesaler as a release valve. He sells inventory upstream, gets paid, and keeps the business moving. The wholesaler, in turn, relies on bank credit to fund those purchases, hedges the price risk, ships the metal, and closes the loop. That loop is the market. When it works, no one thinks about it. When it breaks, everything freezes. Right now, wholesalers are saying no bid. That means the release valve is closed. The local dealer can't offload inventory. If he keeps buying from the public, his cash gets trapped in metal. Rent, payroll, insurance, none of those accept silver. So the dealer hesitates. Then he stops buying too. This is how a liquidity freeze spreads downward. The key insight is this: physical silver doesn't move because people want it. It moves because money moves faster than metal. The entire structure depends on short-term credit, overnight settlements, and constant turnover. Wholesalers are not vaults. They are pumps. And pumps don't work without power. Once bank funding tightens and margin requirements rise, the pump loses pressure. It doesn't matter how many buyers are waiting downstream. If the wholesaler can't write a check upstream, the trade doesn't happen. That's why this moment feels strange. Demand is visible everywhere. But the middle layer, the one that connects buyers and sellers, is quietly shutting down. And when the middle stops, the market doesn't fall apart loudly. It simply stops moving. At first glance, the situation feels impossible. Silver prices rise sharply. Demand is strong. Inventory is scarce. By every surface-level rule, the companies sitting in the middle of this market should be thriving. Yet they are the ones freezing transactions, pulling bids, and quietly failing. To understand why, you have to abandon the idea that price alone keeps a market alive. What actually keeps a market functioning is liquidity under stress, the ability to fund trades, absorb volatility, and survive short-term losses long enough to complete long-term transactions. That is where the breakdown is happening. Start with the simplest piece, the phrase "sold out, but no bid." Sold out tells you supply is tight. That's straightforward. No bid tells you something much more serious. The buyer of last resort has stepped away. In a normal physical market, wholesalers exist precisely to catch metal when it comes back into the system. They are the shock absorbers. When retail demand spikes, they distribute inventory. When retail selling increases, they absorb it. The fact that they are refusing to do the latter is not a comment on value. It is a comment on capacity. Wholesalers do not operate like long-term investors. They are not stacking silver because they believe in monetary collapse. They are logistics businesses. Their model is simple and brutally efficient. Buy metal slightly above spot, sell it slightly higher. Repeat the process thousands of times. Their profit margins are razor thin. Their survival depends on volume and velocity. And volume and velocity depend on credit. A wholesaler does not pay for millions of ounces of silver with idle cash sitting in a vault. They rely on revolving credit lines from commercial banks. Those credit lines allow them to buy inventory from mints and refiners, ship it to dealers, and repay the loan when the sale clears. In a stable price environment, this system works smoothly. It has worked for decades. But embedded in that system is a condition imposed by the banks: hedging. Banks do not lend tens or hundreds of millions of dollars to bullion dealers without protection. They know that between the moment a wholesaler buys silver and the moment it is sold, the price can move. If silver drops sharply, the collateral backing the loan loses value. To mitigate that risk, banks require wholesalers to hedge their inventory in the futures market. The logic is simple. If the wholesaler buys physical silver, they immediately sell an equivalent amount of paper silver. They short the futures contract. On paper, the position is delta neutral. If the price falls, losses on the physical inventory are offset by gains on the short position. Risk appears neutralized. This is the protective mechanism. And under normal conditions, it works. The flaw appears when the market stops behaving normally. When silver rises modestly, the hedge still functions. Gains on physical inventory are offset by losses on the short. Over time, as inventory is sold, both sides unwind. The wholesaler earns the spread and moves on. But when silver goes vertical, the math changes, not in theory, but in timing. As prices surge, the value of the physical silver sitting in a warehouse rises dramatically. On a balance sheet, the wholesaler looks healthier than ever. Assets are up. Net worth appears strong. From the outside, it looks like a winning position. But the futures market does not operate on balance sheet logic. It operates on daily settlement. Every day the price rises, the short futures position loses money. And those losses are not theoretical. They are not deferred. They are collected immediately through variation margin. The exchange calculates the loss at the end of the trading session and demands cash, real, liquid dollars, to be wired the next morning. This is the moment where the hedge turns from protection into a trap. The gain on physical silver is unrealized until the metal is sold. The loss on the paper short is realized every single day. Cash flows in only when inventory moves. Cash flows out constantly as long as the price keeps rising. As silver climbs from one level to the next, margin calls grow larger. Tens of millions become hundreds of millions. The wholesaler pays them using operating capital. That capital is the same pool of money used to fund new purchases, pay employees, ensure shipments, and keep the business running. This is what asset-rich, cash-poor looks like in real time. At first, the wholesaler absorbs the margin calls. Then they draw down their credit lines. Eventually, those lines reach their limits. At that point, every available dollar is being used to defend the hedge, a hedge that was supposed to reduce risk. Now the incentive structure flips. Buying more physical silver would require even more hedging, which would increase margin exposure. Selling existing inventory may relieve some pressure, but if inventory is already sold out, there is nothing left to liquidate quickly. The business becomes trapped between rising prices and shrinking liquidity. This is why no bid appears. The wholesaler is not refusing to buy silver because it lacks value. They are refusing because buying would require cash they no longer have, and credit they can no longer access, to support a hedge that is actively draining them. At this stage, the banks step in, not to help, but to protect themselves. From a bank's perspective, rapid price increases equal volatility. Volatility increases risk. Risk models respond by tightening lending standards. Collateral allows less borrowing. Haircuts increase. A credit line that once funded millions of ounces now funds a fraction of that amount. Even worse, the absolute size of the credit line may remain unchanged while its effective capacity collapses. When silver was cheaper, a fixed line could finance far more inventory. As prices rise, the same line buys less metal. The pipe narrows just as demand surges. This creates a paradox. The market looks hotter, but the infrastructure supporting it becomes weaker. Banks may also reassess counterparty risk. Wholesalers with large, stressed hedge positions suddenly look fragile. Credit committees become cautious. Extensions are delayed. Renewals are denied. In some cases, lines are reduced or called back. From the outside, this looks irrational. Why pull credit from a business experiencing record demand? But banks do not lend based on demand. They lend based on volatility-adjusted risk. A vertical price chart triggers alarms, not enthusiasm. As credit tightens, the wholesaler loses the ability to function as a middleman. They cannot buy from dealers. They cannot buffer flows. They cannot provide liquidity. The system that depended on them begins to seize. This seizure spreads downstream quickly. Local coin shops rely on wholesalers not just for inventory, but for cash flow management. They buy metal from the public with the expectation that they can sell it upstream. When that outlet closes, their capital becomes locked in inventory. Holding silver may be good for wealth, but it is bad for running a small business with monthly bills. As cash dries up at the retail level, dealers begin limiting buybacks. Then they stop buying altogether. The no bid condition propagates from the wholesale tier to Main Street. At this point, the market does not crash. It freezes. Trades don't clear. Inventory doesn't move. Spreads widen. Premiums become erratic. Price discovery weakens because fewer transactions are occurring. The official price becomes less representative of real-world conditions. This is not how markets usually fail in textbooks. There is no dramatic collapse in demand. There is no sudden flood of supply. Instead, the failure is mechanical. The system designed to move metal cannot handle the speed and magnitude of the price move. The irony is brutal. The very tools designed to stabilize the market, leverage, hedging, centralized clearing, become the mechanisms of breakdown when conditions shift too quickly. In this environment, high prices are not immediately beneficial to intermediaries. They increase stress, not profits. They expose structural weaknesses. They reveal how dependent the market has become on cheap credit and smooth derivatives functioning. And that brings us to the turning point. What looks like a silver story is actually a liquidity story. What looks like a commodity shortage is actually a credit contraction. The price of silver did not break the market by being wrong. It broke the market by moving faster than the financial infrastructure could adapt. This is why focusing on price alone misses the signal. The signal is in the bid, or more accurately, in its absence. When the middle layer of a market cannot transact, value does not disappear, it relocates. And that relocation forces a change in how the market functions, how prices form, and who controls access. That realization sets up the next turn in perspective. This event, is not just a failure. It is a switch, one that redirects the flow of metal away from centralized channels and towards something older, simpler, and far less leveraged. And once you see it that way, the question is no longer, why is there no bid? It becomes, what kind of market emerges when the middle can no longer stand? At this point, it's tempting to frame everything we've discussed as a failure, a breakdown, a collapse, a malfunction that needs to be fixed. But that framing misses something important. What's happening in the silver market is not just a failure. It's a reveal. The no-bid moment is not the disease. It's the symptom. It's the system briefly telling the truth about how dependent it has become on leverage, short-term funding, and derivatives to move something that is supposed to be tangible and finite. For decades, price discovery in silver has been outsourced to centralized mechanisms. Futures contracts, credit lines, and hedging models were treated as neutral tools, plumbing that quietly did its job in the background. As long as price moved slowly and predictably, no one questioned the structure. But when silver stopped behaving like a typical commodity and started behaving more like a monetary asset revaluing under stress, the structure cracked. This is the key shift in perspective. The market did not break because silver went up. The market broke because the system required silver not to move too fast. When price acceleration exceeds the tolerance of credit models and margin systems, intermediaries are forced to retreat. They don't disappear because the asset lost relevance. They disappear because the rules they operate under no longer make sense in the new environment. Seen through this lens, the wholesale freeze is not irrational. It is defensive. It is the system choosing survival over participation. And that choice has consequences. When the middle layer steps back, price formation begins to migrate. The authority to define value slowly shifts away from screens and settlement desks toward actual transactions between holders and buyers. The official market doesn't vanish, but it becomes less central. This is how bifurcation begins. Not with a declaration, but with silence. Not with a crash, but with missing bids. The screen still shows a price, but fewer people can act on it. Once you recognize this, the event stops looking like an anomaly. It starts looking like a switch, a moment when a centralized pricing structure quietly gives way to something else. To understand what replaces it, you need a metaphor that captures the mechanics, not the headlines. Think of the silver market not as a warehouse full of metal, but as a circulatory system. Silver itself is the tissue. It exists. It holds value. It doesn't disappear. But what keeps that tissue alive is blood flow, cash, credit, and settlement. For years, the heart of that system has been short-term financing and hedged intermediaries. Wholesalers acted like capillaries, constantly moving metal from refiner to dealer to end buyer. As long as the heart kept pumping, as long as banks extended credit and futures markets absorbed risk, the system appeared healthy. What we're seeing now isn't a lack of silver. It's cardiac arrest. The blood is still there, but it's no longer circulating. Margin calls drain cash from one side. Credit limits clamp down on the other. The heart hesitates. The capillaries collapse. And suddenly, parts of the body go numb. This is why the symptoms feel so strange. Shelves are empty, yet no one wants to buy. Prices are high, yet businesses are failing. Those contradictions only make sense once you separate value from flow. You can own the most valuable tissue in the body, but without circulation, it cannot function. Markets behave the same way. When flow stops, structure matters more than price. And when structure fails, activity migrates to wherever circulation can still happen. That's the pivot we're living through now. And it leads directly to the most important question, not about what will happen, but about what could happen if these conditions persist. This is the point where caution matters most. Not panic, not prediction, but conditional awareness. If volatility in silver remains elevated, banks are unlikely to loosen credit quickly. Risk models don't adapt emotionally, they adapt mechanically. When charts look vertical, haircuts tend to rise, not fall. And if haircuts rise, the amount of metal that can be financed shrinks further, even if demand stays strong. If wholesalers remain constrained, the pressure doesn't stay contained at the top. It migrates. Local dealers feel it next. Buyback programs become selective, then conditional, then unavailable. Not because dealers don't want inventory, but because holding inventory without an exit drains operating cash. If that continues, spreads widen. The gap between what a dealer will sell for and and what they are willing to buy back, it grows larger. This isn't greed. It's self-defense. Wider spreads compensate for volatility, uncertainty, and the risk that upstream liquidity won't be there when needed. If spreads widen enough, trading slows further. People hold tighter. Velocity drops. The metal that's already in private hands stays there longer. Recycling supply weakens. Refiners see fewer returns. That feeds back into the physical shortage, not because silver vanished, but because the pathway back into the system narrowed. And if price on screens continues to diverge from prices in actual transactions, confusion increases. New participants struggle to understand what silver is worth. Experienced holders become reluctant sellers. The official price remains visible, but less actionable. None of this requires a collapse. It doesn't require hyperbole. It only requires persistence. Markets don't need to break loudly to change character. They can harden. They can become less liquid, less transparent, and more fragmented over time. The key risk for participants is not owning something valuable. It's assuming that liquidity will always be there on demand. That assumption holds in stable systems. It weakens in stressed ones. So the warning is simple and conditional. If credit remains tight and volatility stays high, then the ability to convert silver into cash through traditional channels may remain impaired, even as its perceived value rises. Understanding that distinction removes surprise. And in markets, avoiding surprise is often more important than predicting price. At moments like this, the most useful thing isn't prediction. It's observation. When liquidity is under stress, the market sends signals, not always through headlines or charts, but through small, practical changes in how trades actually happen. The first signal to watch is the real bid. Ask spread at the local level. Not the theoretical spread on a screen, but the difference between what a dealer will sell for and what they're willing to buy back at. When that gap widens noticeably, it's a sign that liquidity risk is being priced in. Dealers aren't making a call on direction, they're protecting cash. The second signal is buyback conditions. Ask a simple question. Is the dealer quoting firm buy prices, conditional prices, or no prices at all? A shift from firm bids to call us later, or it depends on quantity, often precedes a full no-bid environment. It tells you upstream outlets are uncertain or constrained. Third, watch premium behavior relative to availability. Rising premiums can mean two very different things. Sometimes they reflect genuine scarcity. Other times, they reflect fewer competitors left standing. If inventory is scarce and competition is shrinking, premiums tend to overshoot. That's a structural signal, not a speculative one. Fourth, pay attention to delivery times and settlement friction. When lead times extend, minimum order sizes increase, or payment terms tighten, it's usually because intermediaries are rationing liquidity. These changes rarely make headlines, but they are among the earliest indicators of stress in the physical pipeline. Fifth, keep an eye on the tone of credit-sensitive news, even indirectly. Rising short-term rates, changes in margin requirements, or commentary about increased collateral haircuts all feed into the same mechanism. You don't need insider access to see this. When financing becomes more expensive or more conditional, market-making capacity contracts. And finally, observe price consistency across venues. If quoted prices begin to vary widely depending on where and how you transact, online versus local, retail versus private, that dispersion is telling you something. It suggests price discovery is fragmenting and liquidity is becoming more situational. None of these signals, on their own, tell you what will happen next. That's not the point. Together, they help you understand where friction is building. Markets rarely fail all at once. They degrade. They become uneven. They work for some participants and not for others. If you can read those differences as they appear, quietly at the edges, you're far less likely to be caught off guard by a system that looks functional on the surface but behaves very differently underneath. And that brings us to the final question, not about silver, but about markets themselves, when the rules stop being universal. If you step back from the mechanics for a moment, a quieter question starts to emerge. What does it mean for a market to be healthy? For years, we've been trained to answer that with price. Higher prices mean strength. Lower prices mean weakness. Liquidity is assumed. Access is assumed. The ability to transact is taken for granted. But what we're seeing now challenges that assumption. Here is an asset whose value is widely recognized. Demand remains visible. Supply is constrained. And yet, the ability to trade it through familiar channels is becoming uneven. Sometimes available, sometimes conditional, sometimes absent altogether. So ask yourself this: if an asset is rising in price but becoming harder to buy back, is that strength or is it friction? If a screen shows a price, but fewer participants can act on it, where does real price discovery live? On the chart? Or in the transaction that actually clears between two people who trust each other enough to exchange cash for metal? And if liquidity is no longer universal, if it depends on timing, location, and relationships, are we still talking about one market or many smaller ones forming at the edges? These aren't questions with clean answers. They're prompts. They're ways of noticing when a system begins to change character, not all at once, but quietly. Because markets rarely announce transitions. They hint at them, through missing bids, through widening spreads, through the small discomfort of realizing that something valuable isn't always easy to move. So here's the question I'll leave you with. If liquidity is the true test of value, what happens when value rises, but liquidity doesn't follow in step? I'm curious how you're seeing this play out where you are. If you've stayed with this analysis to the end, you can probably feel the shift in perspective. This was never really about predicting where silver goes next. It was about understanding how markets behave when liquidity leaves the middle. Moments like this tend to get louder over time, not because prices explode overnight, but because the small frictions add up. Missing bids, conditional buybacks, wider spreads, longer lead times. None of those look dramatic on their own. Together, they tell you the system is under strain. That's why this channel exists. Not to shout forecasts, but to trace mechanisms, the plumbing behind prices, while there's still time to think clearly. If you find this kind of breakdown useful, make sure you subscribe to the channel. In the next videos, we'll go deeper into the parts we only touched on today. How margin calls actually work day by day. Why banks tighten credit right when demand looks strongest, and how price discovery changes when markets fragment. You don't need to agree with every conclusion to benefit from understanding the structure. Markets reward clarity more than conviction. So subscribe, stay curious, and keep watching how the system moves, not just where the price ends up. Because when liquidity starts to matter more than headlines, being early to understanding is often the only real edge.